Welcome to Factful Finance. Imagine this. You wake up one morning, check the stock market, and see your portfolio up by 10%. A week later, it's down by 5%. Sound familiar? It's the roller coaster ride that so many investors face. But how does it all work? How are stocks valued in the first place? And why do their prices fluctuate so dramatically? Well, today we're diving deep into the world of stock valuation and price fluctuations. And trust me, by the end of this video, you'll have a much clearer understanding of how it all ties together. First off, let's tackle the question: how are stocks valued? In the simplest terms, a stock is essentially a share in a company's ownership. But the tricky part? Valuing that ownership is not as straightforward as you might think. The stock price is determined by the market, which means it's a reflection of what investors are willing to pay for it at any given time. This price is influenced by both fundamentals, like the company's revenue, profit, and growth potential, and market sentiment, which can be driven by news, rumors, or even social media trends. Let's take a deeper dive into the fundamental side of things. When investors look at a company, they're assessing its current financial health and its future potential. Think of a company like a cash machine. The more cash it generates, the more valuable it is to investors. For example, if you have a company that's consistently profitable, growing its revenue and expanding its market share, investors will likely view it as a safe bet, and that increases its stock price. This is why financial statements are so critical. The balance sheet, the income statement, and the cash flow statement help determine a company's true worth. Now let's talk about something that can make stock prices move even more dramatically: market sentiment. This is where the psychology of investing comes in. When investors feel confident in the economy or a particular sector, stock prices can skyrocket, even if the company's fundamentals haven't changed much. But when uncertainty creeps in, whether due to an economic downturn, a political event, or just a few negative headlines, prices can drop just as quickly. Remember, stock prices are not just based on how a company performs, they're also about how the market feels about its future. This leads us to the second part of the question: why do stock prices fluctuate? The short answer: it's a constant tug of war between buyers and sellers. If more people want to buy a stock than sell it, the price goes up. If more people are looking to sell, the price goes down. But here's the kicker: this buying and selling is often driven by emotions. In fact, a significant portion of price fluctuations is driven by things like fear, greed, and even herd mentality. Think about it. When news of a breakthrough product or a new CEO makes headlines, investors might rush to buy the stock, pushing the price higher. On the other hand, bad news, like a product recall or disappointing earnings report, can send prices tumbling. But it's not just the emotions of individual investors at play. Let's zoom out a bit and consider the broader picture. Global economic trends, interest rates, inflation, and even geopolitical tensions can all influence stock prices. For instance, when interest rates are low, borrowing is cheaper, which can spur economic growth and raise stock prices. However, if inflation starts to rise, it might prompt the Federal Reserve to increase rates, which could cause a slowdown in the market, resulting in falling stock prices. Let's bring this to life with a real-world example. Meet Olivia, an investor who's been tracking the stock of a tech company called Nexus Tech. For months, Nexus Tech has been outperforming the market thanks to strong quarterly earnings reports and new product launches. Olivia's feeling good about the stock, but then, one day, a competitor announces a new technology that could outpace Nexus Tech's product. Immediately, the market reacts. Nexus Tech's stock price drops by 8% in a single day. Why? It wasn't just about the fundamentals, it was about the market's reaction to potential future competition. Investors panicked, and that sent the stock price spiraling. The real takeaway here? Stock prices are unpredictable in the short term. There's a lot of noise in the market. External factors, economic conditions, and investor sentiment all play a role in determining where prices go next. But if you're in this for the long haul, it's important to focus on the fundamentals and not get swept up in the daily ups and downs. Now you might be wondering, how can you avoid getting caught up in these fluctuations? The answer lies in diversifying your portfolio. By spreading your investments across various sectors and asset classes, you can reduce the impact of individual stock price swings. And always remember, keep your emotions in check. Markets are volatile, but with patience, discipline, and a solid investment strategy, you can weather any storm. This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. If you found this video helpful, you're going to love what's coming next. Want to learn more about managing your investments in a way that minimizes risk and maximizes returns? Make sure to hit the subscribe button so you don't miss out on our next deep dive into the world of financial economics. And if you have any questions or thoughts, drop them in the comments. I'd love to hear from you. See you in the next video.